In this module, we're going to be discussing the accounting cycle. This is the name, the term given to the process of accounting from the very beginning to the very end, and every company will go through it every time they have a new financial statement period. So, as an overview, the life of any company is going to be broken into various periods of time. We don't just want a set of financial statements for the entire life of the company. We need to see perhaps monthly statements, maybe annual statements. If it's a publicly traded company, you're going to see quarterly and annual financial statements. These are required by the SEC, Securities and Exchange Commission. So the accounting cycle that we'll be talking about is actually completed for each and every period that it prepares financial statements, whether it does them on a monthly basis, quarterly, yearly, whatever the case may be. The other thing I want to mention here is the steps that we're going to discuss today may be slightly different than what you see in different texts. I've seen a few different texts. I've used different texts through my teaching, and again, some of them talk about it in a different way. They may break it out in even more detail, or some of them merge steps together. So we're going to see the same basic order. For most courses, it's not important that you remember and you memorize what is step 4. Nobody's going to really ask you what is step 4 of the accounting cycle. What you want to know is if you see all these steps, what is the proper order? So just basically, kind of logically, what would you do first, then second, then next after that? So regardless of the text you're talking about, the order is going to be the same. It's just how much detail they give you. They could turn it into a 15-step accounting cycle if they really want to. They may be able to crunch them into 6 steps, 5 steps. Just depends on how much detail are they going to put in each step. So we're going to go through the way that I like to teach it. We're going to see these various steps, give a description of what is in each step, and just kind of summarize at the very end. So step 1, the very first thing we're doing in the accounting cycle is analyzing the transactions that took place during this period. Whether it be a month, quarter, we need to know what has happened. So we take a look at the source documents, such as the receipts, invoices, any sort of record, the paperwork, so to speak. Could be electronic, could be paper. Anything that proves that a transaction took place. It'll give you the amount, it'll give you the date, perhaps the parties to the transaction. So after we've reviewed those, we now identify what has taken place. We can see that we bought supplies from the store. We can see that we paid our employees a certain amount of money. We can see that we had a bank statement and we had to pay service charges. We maybe earned some income, some interest income. So part of this is identifying what accounts were impacted by these transactions and were they increased or decreased. So all of this really rolls up into this step 1, analyze transactions. Step 2, this is where we really start what is commonly referred to as the bookkeeping or the accounting. So the first step after you know what transaction has taken place is now you have to journalize it, which is a common term for recording a journal entry. We often refer to this as the general journal. In later modules, we're going to be talking about special journals, but for now, we're just going to put it all in the general journal. The journal is a chronological record of transactions that have occurred throughout the period. So on day 1, here's this transaction that occurred. You'll see every account that was impacted by that one transaction. You at least have to have 2 accounts. We'll see one has to be a debit and one has to be a credit, but you may have more. There could be 2 debits, 3 credits, 1 debit, 2 credits. The quantity of debits and credits does not have to match. It doesn't have to be equal. The only rule is you have to have at least 1 of each. And part of the reason for that is that your dollar amount of debits and credits for every individual journal entry does have to balance out. You could have 2 debits that total up to $100 and have 1 credit that also totals up to $100, and you'll be fine. Again, we have other modules out here that discuss journal entries in much more detail. Step 3 is posting to the ledger. So this is where we take each piece of the entry in the journal entry. So could be 2 accounts that were impacted, and we post that piece of the transaction to its corresponding account. So the example I'm giving here is if an entry required a debit to cash and a credit to revenue, then we take each of those pieces. We'd move the debit to cash over to the general ledger cash account so that we now know what the updated cash balance is. And we'd pull the credit to revenue again over to the revenue account, so now we know what its total balance is. This all leads up, to that point, after we've been posting to all these various accounts, every account will have some balance, or it may be zero. We pull all of these balances together, and we use it to prepare what's known as an unadjusted trial balance. This is the first of 3 trial balances we'll be talking about. This basically is a report summarizing what the balances are from each of the general ledger accounts. And again, it shows what the balance is, whether it's debit, whether it's credit. The key rule here, it's called a trial balance because we have to test to make sure that the debits do indeed equal the credits. If they don't, something's wrong. Step 5. This is required for the accrual basis of accounting, which if we were talking about a publicly traded company that has to follow GAAP, we're going to be using the accrual basis of accounting. So these are adjusting journal entries. Now we're merging the preparation and the posting together into one step. Again, other texts may separate it out here. But some of the examples, we're going to take a look and see what prepaid assets, like prepaid rent, prepaid insurance, again, those are all discussed in other modules, what prepaid assets have been used up during this period. That would be an adjusting entry to record the use of those assets. We could ask what unearned revenue has been earned, another adjusting entry, what expenses and liabilities have been accrued throughout the period. So even though the cash hasn't changed hands, we know that there's an expense and a liability that's been accrued. What revenues or assets have been accrued throughout the period? Again, cash hasn't changed hands yet, but we know there's something we have to record. Step 6, prepare the adjusted trial balance. So this is the second of the 3 trial balances. It has all the same purposes of the first trial balance. It's a summary of the account balances for each of the accounts. The big difference, of course, is that it's going to be after we've prepared adjusting entries. Now, some companies put together what's known as a worksheet. This used to be more popular when everything was paper. You'd have a few columns for your unadjusted trial balance. You'd have a debit and credit column to record all of your adjustments. And then you'd have the next set of 2 columns would record your adjusted trial balance. So every account you'd be able to read across. It started with a debit balance of 100. We adjusted it by crediting at 50. So our remaining balance is only a debit of $50. You'd be able to see how that all happens. But the big benefit of the adjusted trial balance, and the main reason we have to do the adjusting entries in the first place, is to give us data that we need to use for the financial statements. That's the whole goal of this period of accounting, is to record data on the financial statements. So that takes us to step 7. We're going to be preparing those financial statements. Now, there is an order. We start with the income statement. We have all of our revenues, all of our expenses. Those pull over from the adjusted trial balance. And that gives us net income. Revenues minus expenses generates net income. That net income figure moves to the retained earnings statement, and that net income is added to the beginning balance of retained earnings. Then we subtract out dividends to get an ending balance of retained earnings. That ends up going to the balance sheet. That's part of our equity balance, and it's added to your contributed capital, your common stock, all of that. Now, the connection between the balance sheet and the cash flow statement, as you can imagine, is cash. The ending cash balance on the balance sheet carries forward, and it's part of the reconciliation on the cash flow statement. So basically, they are required in that specific order, those 4 statements. and most of the data is going to come from the adjusted trial balance, except for those subtotals and totals, and obviously the links that I just talked about between each of the four statements. So now step 7, we're done. We did the financial statements. Step 8, we're at the end of the period. We've already prepared the financial statements. We're ready to close the books. You've probably heard that phrase before. What we mean by it is we're going to prepare the closing entries, prepare and post. So only certain accounts get closed. These are sometimes referred to as temporary accounts or nominal accounts. These include the revenues, expenses, and dividends. They're all closed out to retained earnings at the end of the period. Now we have a separate module that goes through closing in more detail, but at the end, the balances of revenues, expenses, and dividends move to retained earnings. Now that the closing entries, we're adding our revenues to the retained earnings, subtracting our expenses, subtracting our dividends. That really mimics what's on the retained earnings statement itself. Beginning retained earnings plus net income, which is revenues minus expenses, minus dividends, gives us our ending retained earnings balance. Now, those are the income statement accounts plus dividends that we closed out. Every other account keeps a balance. Our balance sheet accounts keep a balance. All of our assets, all of our liabilities, and all of the equity components, including common stock and retained earnings. Step 9, we're going to prepare a post-closing trial balance. This is the third of 3 trial balances. Keep in mind it's after our closing entries have been posted, so certain accounts won't exist anymore. They'll have 0 balances. All of our revenues, all of our expenses, and the dividends will no longer have a balance. It would all be closed out to retained earnings. So what that tells us is that the retained earnings balance on this post-closing trial balance is going to be different than what was on the adjusted trial balance. Now, the other test, first of all, we want to make sure that all the non-balance sheet accounts have been closed. Second, we want to make sure debits and credits are still in balance. Finally, we have step 10. This is an optional step. Not all that many companies use this in this day and age, but these are known as reversing entries. Now, what they're doing, they're reversing the adjusting entries. That's what they're doing. So the thought here is that we needed those adjusting entries to prepare the financial statements under the accrual basis of accounting. However, some companies like to keep their books on a cash basis. So that's fine. They keep it on a cash basis. They reverse the adjusting entries. And for the most part, with a few other adjustments potentially, this takes you back to cash basis. Now, what will happen here, that's fine throughout the next period, but then at the end of that next period, you're going to need to do adjusting entries yet again to get you back to the accrual basis of accounting so you can prepare the financial statements for the next period. So it's really the reversing entries in many cases are considered a little bit of extra work, really for not a whole lot of a purpose. So that's why a few companies use it. It's just something I wanted to go through. It is out there. And that takes us to the end of our discussion for the accounting cycle. Hopefully this has helped.